Hi, everybody. Welcome to Fast Track Fridays. And today we're going over the hot topic of understanding permanent and temporary buydowns. Now, while there's a lot of hype out there about these two things, a lot of times it comes without complete understanding of what it is. So when it's being offered to your clients, I figured realtors should kind of know what a temporary and a permanent buydown is. Most agents may know, but they may not know the fine details. So here we are to give you the info. So why it matters. Rates are higher these days than buyers are used to. They're technically not terribly high, but they're higher than we've had the past 15 years. Buyers are very payment focused. A lot of them get real in their head about, well, I don't have a 3%, a 4%. I'm going to wait. And we've got to get them out of that mindset because there's times in history where if someone would have waited for a lower rate, they would have rented for 23 years. We've got to remind them that rent is 100% interest. They're not really getting anything from renting. They're just paying somebody else's mortgage, right? So by you understanding what the difference is between temporary and a permanent rate buydown, you could structure offers a little bit stronger. You could leverage seller concessions to help get your buyer into the right mindset and help your buyer feel more confident when making offers. And this is where partnering with a good lender comes in. So let's break it down. I'll start off with the simple one, a permanent buydown. That's exactly what it is. It's permanent. The rate is bought down permanently through paying discount points. Now, the discount points don't mean that their closing costs are lower. It just means that the rate is discounted by paying a fee upfront at closing to have an initial lower rate. It's reduced for the life of the loan. You get a lower payment, okay, for 30 years or 15 years or whatever term that our borrower chooses. And they could be funded by the seller, they could be funded by the buyer, and sometimes even agent concessions can fund it. So pros of this, lower monthly payment, long-term interest savings, and a lot of times I'll use it where I just have no other choice. Like the buyer needs a certain rate because they need a payment in order to qualify. The cons of this, it does have a higher upfront cost. The break-even time may be less. For example, if someone's going to lower their monthly payment $100 a month and it's going to cost them $5,000, when you divide that, it's going to take them 50 months to break even. So having that discussion with the buyer, how long does it take to break even, to make up that money, to save the amount of money that's being invested up front? And it's definitely not ideal if the person is planning on selling or refinancing in the near future. So that's a conversation I usually have with them. So let's look at a rate sheet. This rate sheet was published August 11th. And it's for a $500,000 VA loan. So rates change daily. So when you ask your lenders, what rate do you have? There's so many variables that go into it. Credit score, property type, loan amount, credit score. So it can vary situationally. And I'm with C2 Financial, a mortgage broker. So we partner with over 100 different lenders. So I get to shop my client's rate with all of them. So this just happens to be one client or one particular scenario, snapshot in time. This rate is not available, after like 5 minutes from now. All right. So let's take a look at it. Buyers need to understand that they can select whatever rate they want as long as they can qualify for the payment. So here's a big long rate sheet. The numbers in red equal the cost of buying that rate down. And the numbers in green are lender credit for taking a higher rate. This is a strategy that I used to use years ago with my VA loans when there was just no seller concessions and my veteran clients did not have money for closing costs. So we would offer them the ability to have lender paid closing costs. So for example, at 6.6 this particular day, the APR was about 6.854. They would get $10,828 lender credit to help pay for closing costs. So this is a situation where this was the only way to help to get the borrower in, and we could actually help them. Par rate, what lenders consider par rate, this day would be 5.99. This is as close to 0 points as possible. So this particular day, there was no zero. There was only a cost and a credit right here. So this is the lender fee, the underwriting fee for this particular bank. So the credit would offset the lender fee. What does that mean? Well, they basically get a zero lender fee loan. In section A of their loan estimate, it would actually be negative $18, which is kind of cool. But if the buyer is getting seller credit or if they just want to buy the rate down because maybe they want to avoid a refinance in the future. That's a good strategy. They're planning on keeping this house forever, right? They're going to keep it at least 5-10 years. I go through the break-even point with them. Maybe they want a 5.625. Oh, great. They can go ahead and pay 1.0838 points to buy the rate down permanently. And that would cost them about $5,302. This is a great strategy for agents if you're structuring seller credit, because buyers are very focused on a rate. What if a buyer comes and tells me, hey, I want a 5% rate? Oh, great, you can obtain that for sure. This particular day, it would cost them 3.927 points, which is equivalent to $20,000. Is this a good strategy? Well, I guess it depends on their break-even point and where the money's coming from. So right here, their principal and interest at 5% would be $2,742, and at par it would be $3,062. So $3,062 minus $2,742. That payment is going to give them a $320 a month savings. So we kind of do a reverse engineer on that. Does it make sense for them? 20,057 divided by 320. It's going to take them 62 months to break even on that. So after 62 months, they are going to start saving money. That's 5.2 years. So do we think that's a good move for them? It just depends on the situation, and it depends on the strategy. If the buyer negotiates $20,000 less on that contract, for every 10,000 they drop in price, average monthly payment is going to go down about $60 to $65 a month. So it's going to be a savings of $320. Or if they negotiate a lower price by $20,000, then it's going to save them about $120 to $130. So that's where we kind of weigh the options. Where does it make sense? Strategies for you and your clients. Does it help them? Do they prefer to have a lower sales price, lower loan amount, or do they really want that $320 a month savings versus the $120, $130 a month savings? So small strategies there for permanent buydowns. Temporary buydown is not a permanent buydown. Common sense there, right? A short-term reduction in their interest rate, and there's a variety of versions of them. Usually it's 1 to 3 years. The more common ones are 3-2-1 buy down, where the rate is 3% lower the first year, 2% lower the second year, and 1% lower the third year. And after that, it goes back up to the regular rate. 2-1 buy down is just that 2% lower first year, 1% lower second year. And a 1-0 buy down is the rate is 1% lower the first year, and then it goes up. This one is the most accessible, and I've actually funded lender paid temporary buydowns. Yes, you heard that. Lender paid. So we can do this. There's a way of doing it. And if you're interested in more information, you can always reach out to me. But typically on these temporary buydowns, they're not funded by the buyer. It doesn't make sense for the buyer to fund it, and I'm going to show you why. The seller typically funds it, or I have a bank that will allow the agent to fund it as well. Moving on to our next slide, here's an example of a temporary buydown, a 3-2-1 buydown. This is what it looks like. Going back to our original rate sheet that had our par rate at 5.99 and purchase price 500, loan amount 500. Remember, we were kind of doing a VA loan example. The first year, they would have a payment as if their rate was at 2.99%. That's an $889 a month difference. So how does that work in with the seller credit? The seller would have to fund $10,670.57 that first year. The second year, it's $7,324. And the third year is $3,761. So a total of $21,756 is needed for this temporary buydown. I'm going to put it to you as simply as I can. Temporary buydowns are mortgage payments that are subsidized with seller credit. The seller is putting $21,756 in a little pool of money in a savings account within that home loan. And the bank is pulling from that every single month, the first year, $889.21 to subsidize the payment. The payment is still based off of 5.99, $2,994, but $889 of that is being paid for with seller funded buydown. So the seller is actually funding this money. And this is why it doesn't make sense for this to be funded by the buyer. The buyer could very easily just keep this money, $21,000 in a high yield savings account, keep it in there, control it themselves, and pull money from there every single month to keep their, to make that difference in payment. But if it's seller funded, it makes sense because they're using the seller's money. And here's another beautiful thing about a temporary buy down when it's seller funded. You don't lose that money if you refinance. On a permanent buy down, if you refinance before your break even point, I think our other one was 52 months or 62 months, I can't recall exactly. But if the person refinances within those 5 years, they really didn't save any money if it was buyer funded. If it's seller funded, they still lose that money as well because they never recoup the cost. On a temporary buy down, whatever money is left, let's say they refinance in 10 months, there's still a lot of money left in that temporary buy down account. That money either gets applied by the bank to a principal reduction or closing costs or different things. So that's a very important concept about temporary buy downs is you don't lose that money. 2-1 buy downs, you could see here, the first year, it's a lot more accessible because it's only $11,000 that you have to put out, the seller has to put out. So the first year their payment $610. The next year it's $313. And if rates go down here in the near future, which we're kind of anticipating, fingers crossed, but none of us have a crystal ball, you can use that money and lower the principal reduction or lower the balance of your loan or actually take advantage of it. Okay. And a 1-1 buy down is another example. I've used this in the past where the rate is 1% lower for 2 years, which is great. But really the rate isn't lower. It's still at 5.99, but we are using seller funded money in order to offset the payment for our new homeowner. And then there's a 1-0 buy down. This one, actually, I've used it. It's not a lot of money. It's about $37.61 for this particular scenario. So there is a way of using lender credit to offset this if the rate sheets look good. So if you have a question about that, please reach out to me. So let's go over the quick facts. Temporary buy downs. They do lower your initial payments. It's great for buyers that are expecting income growth soon, or they just want to ease into the payments, or they're anticipating rates to go down here in the near future and they don't want to lose that investment from the seller. They want to be able to tap into it and use it. The cons is the rate does go back up after the temporary buy down period. Really the payment goes up because the rate's always been there. They're just making a lower payment because it's being subsidized by that pool of funds. The buyer still has to qualify at the initial note rate. That buyer has to qualify at 5.99 or whatever it is, the par rate that it's going to eventually be at. On a permanent buy down, if let's say they buy it down to 5.5 or 5.3, they're qualifying at that rate because the payment's not going to go up, right? And this could be confusing without guidance. So I have a ton of worksheets that I do provide my buyers with, and I help them understand how it works. Sales strategies for agents. So how can you use this to help get your buyers off the fence? And also for listing agents to help attract buyers. So builders use these temporary buy downs all the time. And especially if you're in an area that has a lot of new builds, your sellers are competing with new builds. So talk to your sellers about providing some type of seller credit toward a temporary or a permanent buy down. And we can compare the both of them for buyers. This is your payment if you offer $10,000 less in price, or if the seller gives you a $10,000 credit, what can it do for your payment for the first 1, 2, or 3 years? So switch this to how we can, help market the property. The buyers haven't seen these rates in 15 years, as I mentioned before. Some of them have a rate stuck in their head. They've got to overcome that. Shift the conversation from rates to payments. What payment are you comfortable with? I have buyers that are perfectly qualified at a 6.5% rate, a 6% rate, but in their mind, they just struggle with that rate because they're used to 2020 through 2022 rates, 3%, 2.5%, which will probably not come back in our lifetime. Those were kind of anomalies. So ask them what their comfort payment is. Instead of asking for price cuts, ask for credits. Let's do a comparison for your buyer to see which one works better. Credits also often work better than cutting the price, and have them focus. I know they're sick of hearing date the rate, marry the house, but it's not your forever rate. I have people that think, well, over 30 years, it's going to cost me a lot. I'm like, Buyers on average historically refinanced every 5 to 7 years or moved every 5 to 7 years. That timeline has been extended because of what's happened recently, but yeah, they're not gonna, I mean, it's rare that they have the same home and the same exact mortgage for 30 years. Okay. And work with a lender that monitors refi opportunities. Whenever a refi little dip comes in, I'm reaching out to clients. Hey guys, let's do a loan review. Just last week, as a matter of fact, rates kind of took a little dip and I blasted my database. If you want a loan review, reach out. And we were able to get 3, of my past clients a lower rate and even got them almost all the closing costs, paid for with lender credit. So there's strategies that can be used. Let's run custom scenarios together. I will handle the comparisons. Just bring the client. And if you needed more information on this, please just reach out. I love educating real estate agents on what we can do for buyers. Talk to your clients, ask questions, partner with a lender to strategize. I'm here to help you. I'm here to help you grow. I've got 20 years of experience behind me, and I'm always growing and I'm always learning. And we just, we've got a lot of options for our clients, and we focus on educating our buyers. So if you have any questions, please reach out. Sylvia Sanders. I look forward to catching up next week.